what's happening at Columbia University, my alma mater. Let me just show you some of that video right now. And maybe Rob, as he joins us, he'd be willing to comment because it's also his alma mater as well. This is, you can see, let's turn up the volume for a second. This is last night at Hamilton Hall at Columbia University, where students took over Hamilton Hall, and they have since renamed it, they say, in honor of one of the kids who has died in Gaza. Anyway, it's turning into quite a you-know-what storm there at Columbia, and it's really rather remarkable that the president of the university was not able to handle this in a better fashion earlier on. She did tell them that they had to be off campus or that they would be expelled or suspended. And that was, last week? And she didn't follow through with that. And, when you tell the kids bedtime's at 8:30 and then suddenly it becomes 8:45 and 9 and 9:15, well, then the kids have a lot of runway, shall we say. Anyways, we talk about the economic challenges in this country. There's still opportunity out there, and I think it's important for everybody to remember that. I'd love to welcome at this moment into the conversation my colleague, the co-founder of 76 Research. That would be Rob Hordon. Rob, welcome. Good to have you back on the show. You and I talk every day. We've been, of course, I just curious to get your thoughts on Columbia right now. Princeton University apparently has arrested some 11 students. I think that they're looking to suspend them as well. Princeton, where I also know you went to school, not messing around with any of this. Is there a difference at all, before we get into all the economic stuff, just in terms of what you see, in terms of how the administration there at Princeton University, your alma mater for your undergrad, and Columbia, where you did your MBA, how they're responding to the situation?
Yeah. Hey, Trish, great to be with you. Princeton has, President Eisgruber is really responding very, very quickly to this. He was very clear that, none of this stuff would be tolerated. The encampments violate, I think, what they call time and place restrictions, right? So, he's a constitutional scholar. He's a defender of free speech, but he also understands that this is completely antithetical to free speech. So I'm pretty impressed with the way he kind of snuffed this out from the beginning. And I think maybe you were just alluding to with the bedtime analogy. You let these things you let these transgressions occur, and you give an inch, and then next thing you know, you're in this appeasement mode. So it's very disheartening to see what's happening on Columbia's campus as a graduate of that school.
And campuses all across the country right now. I mean, it's really Northwestern apparently really given in with some the demands that the protesters have been making. But as challenging as this particular moment in time is, I mean, one of the things that people always need to remember, I think, is that there's still opportunity out there. I talk about it a lot in terms of personal responsibility, something that you and I both believe in wholeheartedly. And it's one of the reasons why I encourage people to make sure that they invest. It's one of the reasons we founded 76 Research, because we wanted to make sure that people had this sort of conflict-free zone where they could learn about where to invest, how to invest. And I want to do what we call a shameless plug, because one of the very first stocks that you and I recommended in the 76 report, and people can go to 76report.com or 76research.com, this particular stock has been on an absolute tear. And I think Drew has do you have the chart? Because I just want to show versus the S&P. The S&P is basically gone nowhere. It's actually down 0.2%. But our pick, the 76 report pick, is up 13.6%. Now, Rob and I are not in and out of stocks. It's just that we felt that this was a really good opportunity to buy this particular company at that particular level. And sure enough, we were right, 13.6% of an uptick. So that's pretty exciting. A lot of that has to do with sort of the commodity sector, if you would, right?
Yeah, absolutely. So that was a mid-March stock that we profiled in the 76 report. And it was a commodity stock that we felt was, sort of an opportune time. That's kind of our approach to the 76 report, right? Is to kind of, we have several, about 30, 40 stocks across our model portfolios. And then when we see an interesting entry point, that gives rise to, an occasion to kind of highlight it in the 76 report. But yeah, no, it's interesting. I mean, today it's been it's the end of the month. It's been a difficult month. The inflation problem continues to persist and really flare up. Today we had another problematic data point, the ECI, the Employment Cost Index, that came in hotter than expected, 1.2%, which was like the hottest level for the quarter since the first quarter of last year. So that's
all right. Let me jump in and just explain.
Yeah.
Right, for people, help them understand what that means, because it's another indication of inflation. And we might say, oh, well, at least hopefully people are making more. This is an employment cost indication, right? Like an index. So maybe people are making more, but I think the flip side of that is that it's now embedded, right? Like we can just assume there's more and more and more inflation coming in to the equation. And once it's there, it doesn't really go away.
Yeah, and this is wages and benefits. So yeah, the silver lining is that people are getting paid more, but you can kind of also read into it as, at a 4.8% pace, this is like the stickier piece of that inflation puzzle. And, you're targeting 2 to 2.5% long-term inflation rates, but here we have wages kind of and benefits kind of sticking, at almost 5%. We're not really getting there. And I think that's signaling, the market's acceptance that we're potentially entering a kind of a new regime of structurally higher inflation rates. And we see that in 10-year treasury yields. They're pushing 4.7 again. They were 4.2% at the beginning of the month. They were 3.9% at the beginning of the year. And, the outlook for rate cuts is kind of evaporating before our eyes. So inflation is here, embedded, inflation expectations, forward expectations are drifting up. And it's certainly a headwind for bonds. It's been a headwind for the S&P 500, down 4% in April. And, but there are winners. And those are the ones that we try to identify in the inflation protection model portfolio. Gold is up something like 15% over the last 2 months, and copper is up north of 20%. That's a theme that we've been highlighting. And,
we got a great chart for that too. I actually jumped the gun and showed this by mistake a little bit earlier in the program. But Drew, if you still have that chart, we were looking at commodities earlier, and you could see copper, for example, gold. I mean, really just all on a tear. Forgive me, that's gold versus the monetary base, which is an excellent chart. Excellent chart. We can talk about that too. But this one right here, Rob, walk us through this. I mean, you've got gold, you've got copper, and then you've got basically, the bond ETF. And the S&P 500, and you can see like the copper and gold are way outpacing what the overall market or treasuries would be doing right now.
Yep. So this is that chart shows the past 2 months, and you've got this kind of increase in those two commodities, and just the headwinds from rising inflation and rising interest rates, bringing down stock market valuations and certainly bringing down treasury valuations. It's interesting. A question that I have is really, does the Fed have the tools to get the inflation problem under control? And this is something we talked about in the 76 report in the most recent issue. There's this idea that, you hike rates and that's that. And then all of a sudden we'll be back to 2% inflation and it's normalized. It doesn't seem to be working. And I think, it raises a lot of questions that people have been raising. Do interest rate hikes really even get the job done, or are our problems more structural in nature and more on the supply side and the cost side? So that's kind of where we get into this idea of structural inflation, that it's almost beyond the reach of, or beyond the realm of control of the Fed to really get a handle on.
Right. No, I think that's the fear right now. You've basically got this embedded into the economy, and it's the runaway train.